It's Friday night. You've finished dinner, reach for your wallet, slide your card into the machine, and it just blinks. Transaction unavailable. You try again. Same message. Then your banking app stops loading. Your group chat lights up. Is your card working? By midnight, it's everywhere. Credit cards across the country aren't processing. Not Visa, not Mastercard, not Amex. For 7 days. No hacks announced, no explanation, just silence. We swipe our cards about 160 million times a day in the United States alone. Most of those purchases aren't backed by cash sitting in a checking account. They're backed by trust. Trust that when you tap plastic, invisible systems talk to each other in milliseconds and say approved. So what happens when that trust pauses for 1 week? Day one feels like an inconvenience. People switch to debit cards. Apple Pay pulls from bank balances instead of credit lines. Some don't notice at all. Others do, fast. Hotels that require credit cards for incidentals start turning guests away. Car rental counters freeze. Online subscriptions fail quietly in the background. Credit cards aren't just spending tools. They're identity verification systems. They're insurance. They're short-term loans. When they stop, a lot more stops with them. By day two, the pressure builds. Gas stations see lines forming at ATMs. Restaurants put up handwritten signs, cash or debit only. Some small businesses quietly panic. Roughly 30% of consumer spending in the U.S. runs through credit cards. That's trillions of dollars a year, about $5 trillion in purchase volume. Even a week-long freeze represents nearly $100 billion in transactions that suddenly have nowhere to go. Not all of that disappears. Some shifts to debit, some to cash, but a big portion simply vanishes because credit doesn't just facilitate spending, it expands it. Here's the uncomfortable math. When you pay with credit, you're often spending future income, next month's paycheck, or the one after that. Credit cards extend over $1 trillion in revolving balances nationwide. That's borrowed consumption. Pull that lever out for a week, and spending doesn't just reroute, it contracts. Retailers feel it first. Big box stores see sales dip. E-commerce platforms report failed checkouts. Travel bookings slow to a crawl. Airlines and hotels rely heavily on credit transactions, not just for convenience, but for chargebacks, fraud protection, and delayed settlement. Without credit networks clearing transactions, risk rises, so businesses tighten up. Then there's the psychological effect. Credit cards create frictionless distance between you and your money. You don't see cash leave your hand. You don't feel your bank balance drop in real time. Studies consistently show people spend more on credit than with cash or debit, sometimes 10 to 20% more. Take away the card, and spending behavior shifts almost instantly. Carts shrink. Impulse buys disappear. It's not just a technical outage, it's a behavioral shock. By day three, certain cracks widen. People who rely on credit to float expenses between paychecks start to feel exposed. Nearly half of Americans carry a balance month to month. For them, credit isn't a reward strategy, it's liquidity. It's groceries on a Wednesday when payday is Friday. It's a car repair that can't wait. If credit lines freeze, not just new swipes, but access entirely, then short-term financing for millions disappears overnight. Payday lenders see a surge, so do buy now, pay later platforms, assuming they're still functioning. Some fintech apps rely on the same card networks for funding rails. If those rails are down, alternative systems strain too. And behind the scenes, something else is happening. When you swipe a card, the merchant doesn't get paid instantly. The card network authorizes the transaction, the issuing bank fronts the money, and settlement happens later, usually within 1 to 3 days. That constant flow is like oxygen for businesses. Interrupt it, and cash flow tightens. Large corporations can absorb a week. Small businesses? Not always. Payroll deadlines don't move just because the network is down. Suppliers still want payment. Rent is still due. Day 4 is when headlines turn sharper. Markets don't like uncertainty. Payment networks are publicly traded giants. If investors suspect structural weakness, cyber vulnerabilities, systemic risk, regulatory intervention, stock prices wobble. Financial news anchors start using phrases like contagion and confidence shock. Because here's the deeper truth. Modern economies run on payment plumbing, not gold, not even dollars, infrastructure. Credit cards are part of a massive web of clearinghouses, banks, processors, and data centers. When they hum, no one notices. When they stall, we suddenly realize how centralized convenience really is. And here's the irony. We talk about living in a cashless society like it's sleek and inevitable, but remove one key digital layer and we rediscover how dependent we are on private companies to mediate everyday life. These networks aren't government utilities, they're corporations. Their uptime is a pillar of economic stability. So, after 7 days, the networks come back online. Transactions clear, the backlog processes, life resumes. The headlines fade. Most people swipe again without thinking. But maybe the more interesting question isn't what happens during the outage, it's what it reveals about the week before it. If a single layer of private payment infrastructure pausing for 7 days can shave billions off spending, stress small businesses, rattle markets, and expose how many households live on borrowed time, then how stable is a system built on constant access to tomorrow's money? And if that access ever becomes uncertain, not for 7 days, but longer, what else in the economy stops blinking green?